Welcome to Barjeel Geojit Securities. We are wealth builders, guiding customers since 2001. We have serviced over thousands of them till date, and we've earned that trust by telling, not selling. We educate you on the investment opportunities that are ideal for you. We offer comprehensive insights across a wide range of products through a holistic approach. Barjeel Geojit Securities. Come, let's talk.
Our section, Indian Market Outlook and Launch of SBI Multicap Fund. Before starting this section, kindly accept apologies from our CEO Krishnan Ramachandran as he cannot able to moderate this session due to unscheduled trip to India. We have started webinar session since first lockdown, and we are so glad that we could able to bring the best of investment gurus to shape up our clients' investment decision. After the sharp recovery of March low 2020, we got an excellent rally till October. After October, we are seeing some kind of volatility, which could be a normality for many seasonal investors, but it could be a first-time experience for newcomers to the market. This point of time, we have some kind of geopolitical issues between Russia and Ukraine. Then crude is on multi-year high, and gold is on very close to the historical higher levels. This point of time, we are getting Mr. Ruchit Mehta. He's head of research, SBI Mutual Fund, India's largest asset management company. Mr. Ruchit is joined in SBI Mutual Fund in the year of 2010. Then he is with the SBI for the last 11-12 years. Before joining to SBI, he was with the HSBC as assistant fund manager. Before joining HSBC, he worked with the ASK and Prabhudas Leeladhar for 2 years. This point of time, I also welcome our clients from Oman and rest of the GCC to this webinar session. I would encourage all our clients to put your question and answer section under Q&A section available on your screen. After the session from Geojit, we'll try to answer the best of the question from the group. Now, I would like to invite Mr. Geojit to start your session. Thank you.
Thanks, George. Thank you so much for your time. And good morning, everybody. And thank you so much for joining in today on a Saturday morning. We hope to be able to give you a perspective of the equity markets from what we as SBI Funds think about it. And we also talk a little bit about our new fund, which has been just recently launched on Monday. So in terms of where we are in the equity markets, January and February have been fairly volatile. The volatility has been on accounts of multiple factors. As George talked about some sort of geopolitical risk factors that are there, but we think that such events tend to be more of noise rather than truly impacting or worrying the markets. What really is worrying and impacting markets at this point in time is the rise of inflation globally and the trend of inflation, which has been much higher than what was being anticipated. Towards the second half of last year, it was anticipated that as we went out of the pandemic and it came to a near normal sort of situation with regards to economic activity, inflation would come back. And the causes of inflation would be that demand had been suppressed for a long period of time. So as people come back to spending, the level of inflation would get higher. There was an expectation that inflation could be in the 4 to 5% mark in the US. What has truly been surprising is that inflation has been north of 7%. So the UK reported the highest level of inflation in more than 2 decades at 5.5%. The US reported CPI at 7.5% recently. Even back home here in India, we have had inflation which is close to 6%. That's there. Now, inflation isn't the worry, but the higher spike itself and the level at which it is what's been the worry for investors. And what it has caused the worry truly is the issue with regards to how the central banks would respond to such high levels of interest rates. As we spoke about the expectation for inflation towards the second half of last year, that had tied into a certain level of expectation with regards to interest rates and what the central bank would do in calendar year 2022. The general expectation was that the Fed would tighten interest rates by three times in a year by 25 basis points each, right? Leading to an approximately 75 basis point increase in the benchmark rates by the US Fed in this year. However, that view has now changed. It has changed because of the way inflation has been much more severe than what we have anticipated. There are three levels of worries now on interest rates. One, will interest rates rise faster than what was earlier being built in? So if we were thinking of interest rates at rising at a pace of 25 basis points, will they rise at a pace of 50 basis points? Will we see interest rates rise ahead and faster? So instead of rising just 3 times this year, would they rise 4 times or 5 times in this year? The second is the level of interest rate. Instead of a 75 basis point hike in the interest rates, would we go much higher? Would it be 7 hikes of 25 basis point or 8 hikes of 25 basis points? And the fourth and worry which is that how long will we have this interest rate rise cycle? How fast it will keep on continuing going forward? Now, what this means for the markets is that equities are what one calls is a discounting mechanism of the cash flows that a company makes. There was an expectation with regards to what the cost of capital should be, and if interest rates are rising very rapidly, then that impacts the cost of capital as well. This increase in cost of capital is what is causing the volatility that's there. Simply think about it. If earlier this year, we were thinking that cost of capital would be say about 10%, but because of a 1 to 1.5 percentage point rise in the interest rate, if my cost of capital has gone to 11%, then that impacts my valuation for an equity asset. For higher priced stocks or higher valued stocks, those with very high PE multiples, such as in fast growing new commerce or new technology companies, the impact is much more severe, and which is what we've observed globally as well as in India. You have seen very sharp impacts on all these new age technology companies that are there. Eventually, markets will settle down. They will anticipate a certain level of interest rate, a certain pace of the interest rate, and the speed of the rate hikes, and it will get factored into the equity market valuations. So what is cause of this inflation per se, right? It's kind of important to understand what's driving this inflation scare itself. There are two aspects to this. One is demand is extremely strong. As we get out of the pandemic and get to more of a normal life situation, you are having a situation where consumers are willing and happy to spend a lot more across product categories. This is causing a higher level of demand that was earlier anticipated. The second and the more stronger cause for the inflation is that we have capacity issues globally. When we think of it, the last round, large amount of capacities were added in any industry. Let's say, for example, you had in the oil and gas industry. The last time a large amount of oil and gas expenditure for large projects, right? Typically, any large onshore oil and gas field or even offshore would take close to 7 to 10 years, traditional oil fields. Shale probably takes about 1 to 2 years to kind of do it. But large oil fields did not see any investments for the last decade or so. New projects really weren't invested into. There were no exploratory works being done. Now, what this means is that you have a shortage of capacity when demand is rising. And one can see that in many industries. We can see that in the steel sector. In India, the last round of capacity expansion on the steel sector happened way back in 2012 and 2014, when Tata Steel had started work on the Kalinganagar project. When we think of it, India is today running close to being full capacity for steel. A country which is abundant in iron ore is looking at a situation where it may have to import steel. That's how much is the supply-demand mismatch that's there. Even for FMCG companies. So we heard commentary from large biscuit makers like Britannia, which talked of that they have run out of capacities and they need to ask their suppliers to ramp up capacities as well. So in general, globally, you have a demand supply mismatch where capacity is a real problem and demand continues to be very strong and healthy. So therefore, when we look at what sectors could look potentially promising going forward, are those which will benefit from this rise of inflation and the rise of interest rates and the capacity shortages that are there. We are bullish on sectors such as manufacturing, industrials, capital goods, engineering firms, and those which are linked to the overall infrastructure activity, because that's something that the government has been very focused upon and is looking to invest a lot more capital behind new infrastructure projects. The second area that we are very positive on is the financial services sector, and there particularly with regards to banks. The last decade, the banks have had a very tough situation because they have faced multiple levels of loan issues where a lot of NPAs have come through, a lot of sectors went bust. Let's take the example of the steel sector itself. The reason the steel sector did not invest much capacity in the last decade was that you had very high levels of bad loans in the sector. Banks were unwilling to lend, prices were low, and companies were making losses. Last 1.5, 2 years has caused a situation where steel companies are making record levels of profits. Debt levels have come off sharply. In fact, if they do not invest into further capacities, many of these steel companies, some of them for the first time in their history, would be sitting on a net cash position on their balance sheet. So therefore, banks in the situation are seeing a complete reversal of the NPA cycle, which is positive for their balance sheet as well as for their profitability. The second, when interest rates rise, typically loans get raised faster rather than the deposit rates. So when loan rates go up and deposit rates takes time, that lead lag impact that is there results into a profit margin expansion for the banking system. The third element is that banking system will see an increased level of loan activity. Loan volumes will go up. One, inflation itself requires an increased amount of working capital. If earlier I needed about 100 rupees worth of working capital, if the inflation on the price is 10%, I need 110 rupees of working capital. So that extra 10 rupees is something that I need to fund. The second is if capacity is the cause of inflation and people are looking to add capacity, you will see the need for project loans as well and long-term project loans. So banks will have an increased volume for loans on both the short end and on the long run. Therefore, we are optimistic on the banking industry from a next to 3 to 5 year perspective. The third area that we are fairly optimistic on is the consumer discretionary sector. As we get back to life being normal, you will start seeing people willing and happy to spend money on products on which they were earlier unable to spend on because there was a restriction, there was a lockdown. And second example, if you think of it on the apparel industry, one of the larger drivers of demand for the apparel industry is the fact that you go to office, you go to school, and you have celebrations and events. None of those three things happened in the last 2 years. People have not bought clothes for office, children haven't had school uniforms, weddings haven't happened, no sort of celebrations have happened. Now, as life gets back to normal, the earliest sign that we see is that people's behaviors haven't changed. Weddings are becoming larger as they were earlier. School uniforms are coming back. And as you go back to office, there is a need for formal wear as well. So there is a big demand boost that is happening on the apparel sector as well. Similarly, for example, the same thing with travel and tourism, restaurants, etc. Automotive is another area in the discretionary basket where we see very strong demand because people have saved a lot of money and therefore are happy to invest money back into buying a vehicle of choice. Now, no longer do you want to do shared driving, but you rather drive yourself. And these are the factors that are driving a lot of expenditure in the consumer discretionary spaces. We also like certain smaller sectors, for example, which will be beneficiaries of the infrastructure boom, which would say, for example, the material sector such as cement, or areas in the infrastructure basket such as real estate. That's that. We are not very optimistic on certain sectors such as pharmaceuticals or consumer staples and particularly consumer staples, because one, we have very high levels of inflation, which does impact consumer staple goods prices, and demand typically does tend to get impacted when consumer staple prices go up. And volumes have been starting to slow down the last 2 quarters. We have seen a sharp slowdown in the volume growth trajectory by the consumer staples companies. Pharmaceuticals is an area where we think the export market could have some bits of challenges as you go past the increased level of demand that had been caused due to the pandemic and you get back to normalized levels of demand. But within pharmaceutical sector, we do like the domestic sectors such as hospitals or laboratories. Technology, we do have a neutralish view. Think that there are certain pockets of technology companies which are doing extremely well, certain pockets where valuations are not justifying investing at this point in time. So broadly, from an equity market perspective, we think volatility will continue. What's happened in January and February, you should expect would continue for the coming 12 to 15 months as we settle down into what level of interest rate, how fast will be interest rates, and how long will the interest rates rise. Until the equity markets gets clarity on this, we will continue to face these challenges. But we would suggest taking advantage of this volatility, befriend the volatility, because what this is leading into is sharp corrections in valuations for many stocks. While headline indices may be down just 8 to 10%, there is a very wide dispersion in many stocks, and you're seeing many sectors or many individual companies get beaten down by 30 or 40% as well. And this is more true on those companies which have very high level of valuations with price earning multiples going above 70 or 80 times. On the bond side, we would anticipate the 7% yield mark to be probably go to 7 quarters, 7.5. And therefore, on the fixed income side, you should anticipate 10-year yields to move to the 7 quarter, 7.5 mark. So there could be some bit of capital erosion because of that, and bulk of it seems to already have been done. September, October, we had hit about 585 on the 10-year, and we already are close to 680, 690 in recent weeks that we have seen. From an economic growth outlook perspective, we anticipate growth momentum to slowly continue to build up. We think the 8.5% GDP forecast could potentially be surprised on the upside. We do think that the government has been very conservative in its estimates for taxation and for growth as well. And the early signals that we see from various fast-moving indicators, such as GST collections, e-way bills, etc., seems to suggest that growth momentum is trending at better than the 8.5% levels that is there. I just chatted a little bit to you about our new fund. And since a lot of you would probably be long-term investors already into equity markets, I'll just walk you through a couple of the key slides of our fund and as to why our fund is unique in the context of the various multi-cap funds that you would have seen out there in the market. The last 12 to 15 months has seen many multi-cap funds being launched as the industry was allowed to have another segment where they could have products available. And when you look at the multi-cap fund construct, right, it requires you to have an investment of 25% each in the mid, large, and small cap segment that's there, with the balance 25 allowing you to have a flexibility to invest on a cap agnostic basis. But the key differentiating factor for us as SBI Mutual Fund is that we are not relying on one individual to invest the portfolio. We are having a combination of the entire investment team work towards it, using the high conviction analyst team portfolio as the basis by which the portfolio would be constructed. Any fund manager out there typically would either be great at large cap stocks or mid cap stocks or small cap stocks. But very few have the ability to consistently do well in all three stock buckets that are there. Our approach will be to use all of the analyst team as well as the portfolio managers, who all of us conduct research to start with, and create what we call as our high conviction analyst team portfolio at the beginning of every month, from which the portfolio manager would essentially construct the portfolio. What is also different in this fund is that we will also have a sector agnostic approach to our stock selection process. If you look at any portfolio that is there, the fund manager has a benchmark against which he gets evaluated. He needs to beat the benchmark on a relative basis, and he also needs to beat his peer sets on a relative basis. What this does create is a situation at which the portfolio manager, because he would like to cut the risk of underperforming the benchmark and cut the risk of underperforming the peer sets, essentially starts by looking at what is the benchmark and then deciding the investment basis what is already in the benchmark. Let me give you an example of the large cap fund space. When we look at it across the industry, there are many large cap funds, and if you look at it, even at SBI Mutual Funds, large cap funds that are there, everyone has a benchmark, which is either the Nifty 50 or the Nifty 100. Those two indices have close to 30% invested into the financial services sector and about 10-11% into the IT services sector. Most funds would have between 25 and 35% invested in the financial services sector. And in the case of IT, it would be between 8 to 15% in IT sector. So even if I am negative a particular sector, I will have an allocation to that sector simply because I wish to cut benchmark risk and peer set risk. In our fund, our approach will be to first select the stock ideas that we like from our high conviction idea portfolio, and therefore the sector allocation will be an outcome of the stocks that we have selected rather than a top-down conscious view that's there. So it is a sector agnostic approach in that sense. The second is that because the 15-member team, which includes 10 research analysts and 5 portfolio managers who also cover sectors, like we had an NFO last year of our Balanced Advantage Fund, which is run by our portfolio manager, Mr. Dinesh Palachandran. Dinesh also looks at the telecom and insurance sector for us. Our large and mid-cap fund is run by our consumer analyst, Saurabh Pant. Saurabh has been looking at the consumer sector for well over 15 years, and he continues to look at the consumer sector for us. So we have portfolio managers and analysts who cover stocks, and they are giving me contribution to the portfolio in terms of the highest conviction ideas. What this helps is it makes the portfolio style agnostic. Every portfolio manager has a particular style. Every individual has a particular style. Somebody may be growth oriented, somebody could be value conscious, somebody could look at momentum and trading, somebody could combine growth with value, somebody's quality oriented, etc., etc. I can only tell you with hindsight bias as to what style worked in during which periods of the market. I have zero ability to predict what style will work in the future. For example, 5 years back, if you would have thought that growth and quality have outperformed value for 7 straight years, it is time for mean reversion to happen and the value should outperform. None of that happened. Value continues to underperform growth and quality for another 5 years. So value stocks have underperformed growth and quality stocks for well over a decade, that's 12 years to be precise. There are many people in our industry who have a value-oriented mindset, and they are not bad individuals. They are phenomenal fund managers, absolutely strong conviction stock pickers, great analysts in themselves, but their style has not worked and consequently they have underperformed. As an investor, should I be taking that risk? And which is why this fund, because it has 15 people contributing to the high conviction list, and each one has a different style, effectively all styles get reflected into this portfolio, and it makes it a style agnostic portfolio. If growth does well, we will have growth stocks. If value does well, we will have value stocks. If quality does well, we will have quality stocks in the portfolio. Therefore, we will not look to underperform simply because style has been out of our flavor. We will look to outperform because style, all sorts of styles are being represented in the portfolio. The third and most important part is that going back to, let's say, our large cap example, if you look at large cap indices, and if you look at large cap funds, most large cap funds will have 5 or 7 names common across the board. You will have the HDFC Twins, you will have Reliance, ITC, Infosys, TCS, Axis Bank, etc. Now, one may say that do all portfolio managers like the same stocks at all points in time? Perhaps the answer is no. What does happen also is portfolio managers, again, because you have to be benchmark conscious and you have to be peer set conscious, you're looking to cut your risk. In the large cap universe, the large cap fund, large cap indexes, if you look at the Nifty 50 index, the top 10 stocks make close to 45-50% of the benchmark. The HDFC Twins and Reliance itself would make close to 25% of the benchmark. If I do not own a Reliance Industries in my portfolio and Reliance Industries goes up by 20% in any given year, I run the risk of having a 2 percentage points underperformance just from the fact that I don't own Reliance at all. As a portfolio manager who has to beat on the large cap index 2% every year, I am running the risk of underperformance starting by that itself. What this means is that the portfolios are therefore a lot more benchmark conscious and they do not have the ability for generating long-term strong alpha. Our approach in this fund will be to first select stocks that we like and only stocks that we are positive on, rather than simply select stocks because they are part of a benchmark or part of a peer set. Therefore, this portfolio represents the highest conviction ideas of the fund house team that's there. So how do these high conviction ideas actually get created? When we look at the invested universe of roughly 2,000 odd companies, which have a market cap over 100 crores, we filter them for liquidity and free for market cap and come to about roughly about 1,200 investable stocks. We actively have looked at about 800 of these companies. 450 of them form part of what we call our passive universe, in which on a periodic basis, every 3 or 6 months, we will run a certain set of filters and screeners to look for performance on various metrics such as growth, EBITDA, profits, etc., return on capital. And then this becomes a place by which we potentially have new stocks ideas to look at. We have another 350 stocks which are part of our active universe. This is where the analyst team has done a fairly high level of detailed work on this. You're not just meeting management, but you're meeting factory workers, suppliers, vendors, customers, regulators, etc. For example, in one of the cases of a financial services company, our analyst actually went to the home state of that company and went to branch by branch, posing as a customer to figure out what were the lending practices, how did the whole experience for a customer be, speaking to customers already at the branch as to why do you come to this bank or this financial services company compared to anybody else, what's the motivator, what's the driver, why did they come to this place. That's on-ground detailed research, something that we will carry out for every company that we are looking to invest in. We will do a detailed financial analysis spanning over 15 years of financial data of a company, do a forensic check on a company, do an ESG check on a company, and then ultimately have a return investment thesis on each company where we focus on why or we want to own or not own the company, where we can go wrong, what is the valuation of the company, what is our fair value estimate, the target price of a company, and the recommendation. Now, the recommendation of the company could be either an outperform rating or an underperform. An underperform is where we expect the company to deliver returns which are going to be below the sector average. An outperformer which could deliver returns which are better than the sector average. And buy ideas which would deliver returns better than the sector average and the sector outperformers. At the same time, would also deliver potentially absolute returns. Out of these outperformer and buy ideas, we will have a curated list of high conviction ideas. So for example, my consumer analyst who covers about 35-40 stocks, and out of those stocks, he probably is positive on 20 of those. Either he has an outperform or a buy idea on those. Out of those 20 odd stocks, he then curates it further and says that which are the top highest conviction stocks within this 20 odd list that's there. It could be 5, 10, 3, 1, or 0. Then those high conviction ideas of the analyst are then ranked from 1 to n. The priority being that if I had to buy only one stock, that would be ranked 1. If I had to buy only 2, then it would be 1 and 2, and so on and so forth. I also put out what we call as a confidence score against each company, which gives you the conviction that the analyst has against each company. How good is the growth profile? How large is the market opportunity? How well has the company grown in the past? What is the capital allocation of the company? How good is the management, etc. All of this results into what we call as a confidence score of each company. Now that confidence score is mapped to each of the ideas. Along with that, we have what is called as a sector view on each company. The sector view could be positive or negative on the company. Once we've done that, the list of 75, 80 stocks then gets filtered into large, mid, and small cap buckets. Those buckets then are then taken by the portfolio manager, wherein the portfolio manager effectively does what we call is an evaluation of the risk of the stock, the ownership of the stock, the ability to size up on the portfolio. And at this stage is when the portfolio will actually get constructed out of the 75 odd stocks. We will invest close to 27% in large cap, 27% in mid cap, and 27% in small cap. The extra 2% is to allow for a buffer for the market movements that are there. We will have close to 4 to 5% every in the portfolio as cash. We will have close to 0 to 10% invested into international stocks, and these international stocks would be part of our high conviction ideas. So in this high conviction list that we have, for example, in the IT sector that is there, if my analyst has international stocks under his coverage and he puts an international stock as part of his high conviction list, that it could be considered as part of this portfolio. And then we have the rest about 4 to 5% left over, which would again be part of this high conviction list stocks that are there. So for example, out of this high conviction list, if about 60% is what the portfolio manager brings it down, accounting for liquidity, stock ownership, etc., he probably, let's say, builds a portfolio of 30, 35 stocks. The balance 5, 6% that is there will then be selected out of those balance 30, 35 stocks which have not been invested out of that original master list that's there. The stocks could be large, mid, or small, depending on what the preference is of the analyst and the conviction of the analyst that's there, and the potential return that the company could generate. This is how we expect the portfolio to be sector agnostic, style agnostic, and we construct it purely on the basis of the highest conviction ideas of the investment team that's there. So I'll stop here, and then we can take any questions that you may have either on our fund or on the markets that's there. Thank you for your time.
So there is a question from the team, like SBI had a multi-cap fund till 2018. Then it's been converted to flexi-cap. Then again, why you are launching another multi-cap again?
Sure. So the multi-cap, originally when the SEBI regulations came through, they wanted the erstwhile multi-cap funds to have a minimum of 25% in each of those buckets that is there. All the multi-cap funds in the industry had become substantially larger. For example, our own flexi-cap fund now had about 16, 17,000 crores of assets. There were some funds which are more than 20, 25,000 crores as well. It was a challenge. A representation was made to SEBI, and therefore the flexi-cap category was created, and we converted what was our multi-cap fund at that point in time into a flexi-cap fund. The two key differentiations between a flexi-cap fund strategy and a multi-cap fund strategy is that one, in flexi-cap, I do have the ability to invest 100% in either large, mid, or small, depending on the view of the portfolio manager and the analyst team. The second is the flexi-cap fund we run as a sector neutral strategy. So there I'm very conscious of my benchmark. I will always look at my benchmark and be within plus or minus 3% of the benchmark. So for example, here, if financial services is 30% of the multi-cap index, then I will have either 27% or 33% in that allocated to the financial services sector. And then within that allocation, the best ideas of the analyst team is what's picked in for the fund. Whereas for the multi-cap fund, it is a completely sector agnostic fund. It will be a smaller size portfolio in terms of ideally 30, 35 stocks, whereas multi-cap can be higher at 50, 60 stocks as well. That's the key difference between the flexi-cap fund strategy and the multi-cap fund strategy. Multi-cap fund, when we think of it as to why we as an investment team are quite bullish on, when in 2008-9, when Navneet and Vasan had joined the company, right, we had a complete pivot away from the way we were managing money. We wanted to move away from what was the prevalent way of managing money, which is to have star or celebrity portfolio managers, and we wanted to make it completely focused oriented. Our first steps towards that was the FlexiCap fund, which 7-8 years back, we converted that into an analyst portfolio. We further refined the process through the years. We came up with the high conviction and the best ideas portfolio of the analyst team. 2.5 years back, we formalized the process and we started mapping it out 2 years back in 2019 to a closed-ended fund of ours called Long-Term Advantage Fund Series 6. And once we were confident of the process and we had the opportunity of launching another fund, we thought this should ideally represent the best fund or best ideas fund of the fund house. And therefore, we came with this fund, which is essentially a representation of the best ideas of the investment team. In FlexiCap, I could own a stock if I'm negative as well, simply because I am looking to cut benchmarkers. In Multicap, we would not do the same thing. We will look only on stocks if we have a positive view on that company.
Another question, like what will be the difference between SBI focused fund, which having around 30-35 stock versus this new NFO?
Yeah. So focused also is a concentrated fund strategy, such as what we would envisage for Multicap to be. There are one key difference between focused and Multicap. Focused is a fund which is run by one single individual. It represents the ideas of that individual rather than the ideas of the entire team. Focus today has about 24-25 stocks. Out of those 24-25 stocks, the overlap between the high conviction idea list of the team and focused is just at about 9 stocks. In the past, we have had stocks which the analyst is negative, but the portfolio manager has chosen to invest into. For example, Bajaj Finance is a stock where we had a very large weight in the portfolio in focused, but the analyst was negative through the large part of the last 3 years that's there. So the portfolio manager can go against the analyst in the focus fund, whereas in the multi-cap fund, the portfolio manager cannot go against the analyst and it has to be a positively viewed stock by the analyst that's there. Second, you run the risk of one person's style working or not. Vasan's style in focus may be working today, may not work tomorrow, or may continue to work tomorrow. We don't know. In case of multi-cap, because all of us are contributing to stock ideas. So while a Bala may be a value conscious person, a Vasan could be a quality conscious person, a Sohini could be a growth with value conscious person, all of those style factors are getting featured into this fund and it makes it style agnostic. That's the key differentiation between focused and multi-cap.
Another question, if Fed is likely to increase 200 basic point interest rate, what could be the impact on world over the market as well as Indian market?
So as I said, the interest rate thing is the biggest challenge. How fast it happens, how quick it happens is where the debate actually is. And equity markets to some sense are starting to price in higher levels of interest rates, faster level of rate hikes, and potentially a longer period of rate hikes, which is what is causing the kind of downfall in markets that is said. Right? Russia, Ukraine is a nice side story. It keeps distracting us from what is actually the real cause of the pain. Maybe adds to the volatility a little bit, but it's the bigger part is actually the interest rate cycle rather than the geopolitical tensions out there.
What should be a fair return expectation from the market for the next 2 to 3 years for a new investor, say the age between 25 to 40 years, who starting their equity allocation, and what could be the allocation you will suggest?
So 2 to 3 years is always very difficult to predict because what may happen is that equities don't work in a linear fashion. Right? The unfortunate part is if you look at a 30-year cycle of equity markets, right, it may look like it's given a very nice, sort of a curve on the returns that you generate, but the interim volatilities can be massive over that period of time. Let's take, for example, 2008, we had the equity market fall close to 65%, right? And the subsequent periods, it had gone up close to double out of that. The same thing in 2020, in the pandemic, equity markets fell 65%, but we've gone up close to 1.5 times after that, right? So equity markets can be extremely volatile. What we do generally is tell investors is that when you think of what should be long-term equity returns, and which is something that one can backtest and see what markets have delivered, is to look at where the 10-year bond is at that point in time and look at the level of inflation that's there. Combine the two, that should be the minimum that the equity market should deliver. So if my 10-year bonds is at 7% today, my inflation is at about 5%, I would anticipate equity returns to be in the 10 to 12% mark over a period of time. However, shorter term, there can be extreme bouts of volatility. So 2 to 3 years would be a very short time frame. Unless you're willing to extend that time frame to 5 years, we would recommend to go perhaps more to more conservative funds such as the conservative hybrid fund or the equity savings fund categories.
See, NRI is always interested to know how the rupee movement going to be. Now, this all geopolitical tension and the crude price movement and everything, but rupee relatively stable in the last few years, we can say. What is your outlook about INR?
So in general, over the long term, we do expect that the INR should keep depreciating against the US dollar because of the interest rate differential that's there. And on average, over the last 5 years, if you've seen, the rupee has depreciated about 2-3% because Indian inflation was about 4%, US inflation was about 2%. So you had about 2-3% INR depreciation, which has only been very stable. However, remains a risk that if in extreme volatility that happens, war breaks out, oil goes to say $120 or $130, then you do see short-term impacts on emerging market currencies. But the balance sheet of India is a lot more stronger than it was in the past. We have very high levels of foreign exchange reserves, I think north of $700 billion. Growth in India has been extremely strong in the recent months, and we can expect the growth to continue. Therefore, there is some part of the market which believes that the rupee could actually appreciate against the US dollar compared to a depreciation. And because the US is in a much more tougher situation today than where India is, where in the US growth could potentially come off over the next 2 years, whereas in India growth could actually pick up, and our deficits and our fiscal situation is a lot more under control. So a stable rupee with a 2% depreciation is our base case assumption, with the risk that you actually see a rupee appreciation.
Are you done any kind of back testing on this portfolio? How many shares likely to be held in this portfolio? What could be the expected alpha and from this particular fund? As per the back testing.
When we had implemented this strategy for our close-ended fund, we had seen in 2 years an excess return of 3.5%. The alpha was 3.5% over 2-year period after expenses. The number of stocks in the portfolio will be a function of the size of the portfolio, because in this fund, the bottleneck will always be the small cap universe, right? If the fund is, let's say, 10,000 crores, and I need to have, let's say, 27% always in small caps, so roughly 3,000 crores for the small caps I need to buy, which is a bit of a manageable number. It's not that big a number. If I want to own, say, 10 small cap companies, 300 crore market cap, I should be able to do that. But as the fund size keeps growing larger and larger, the small caps become the bigger bottleneck, right? And therefore, my number of stocks can go up, right? If the stock portfolio is, say, 20,000 crores, maybe my stock portfolio goes to 40, 45, but that's because the small cap numbers have gone much higher.
So you don't have a number with you, how many stocks you can give because of the small cap allocation, small cap segment allocation. Okay.
Because the small cap is a bottleneck, right? If I have a smaller fund, my number of stocks can actually be lower.
You'll have a challenge because we are expecting a huge collection in this fund, and how you can allocate money to small cap will be always going to be a challenging, right?
Yeah. See, our small cap fund itself is about 11,000-12,000 crores, right? Up to 5,000-6,000 crores of small cap allocation, right? Which would mean, say, 15,000-20,000 crores for the overall fund. It's not a big challenge per se. Though, I mean, people do have a lot of expectations on this fund. Let's see. I mean, it's just been 1 week of the NFO. So we don't know, but the bottleneck always will be the small caps.
I know. If fund is going to be grow very large, then you have to put a stop. Maybe you have to stop it on collection, right?
Yeah, the tail increases.
Yeah, exactly. The question about pharma sector, it was giving very good return in first 2 years after the post-COVID. Now slowly settling down. This is a time to come out from that sector, or still there is enough energy left over?
So pharma had a very good run the last 3 years for two things. One is that obviously when a crisis happens, people go towards more safer havens. So so-called MCG, pharma, IT, they are called safer havens sectors. So people prefer to sort of go into those sectors to invest into. The second is that obviously the crisis was a health crisis, and therefore there was a very strong demand for medication products across the board, and pharma companies saw a very big boost in demand. I mean, everybody has stocked up enough of Dolo at their home, or ibuprofen or paracetamol at their home, and vitamin C's and all sorts of medications people have stocked up also at home. Also, what happened is that because of travel restrictions and the need to keep the supply chain going for pharmaceutical drugs, the US FDA was also a lot more lenient on the Indian industry. Uh, we are just starting to see the first phases of the US FDA getting back to their own on-site inspections and starting their work again, which could cause some bit of volatility again, because uh, we've seen that in the past, right? There are phases in which the US FDA does round of checks. There are always some of the other issues that crop up, and you could see some challenges on some companies. So export-oriented pharma, we are not very positive. Domestic pharma, health, laboratories, hospitals, those are areas that we are quite positive about.
Sorry, my line being disconnected.
Okay.
Okay. There is any allocation you are planning to give to SBI Gold ETF or something during this point of time?
Not in this fund, not for this fund itself. We offer gold as a asset allocation for investors who would like to sort of look at gold as part of their portfolio. And digital gold is obviously a lot more safer and a easier solution rather than holding physical gold that's there.
When you did a back testing of your portfolio, did you see any kind of serious overlapping between other leading multi-cap funds available in the industry, or that kind of comparison is available with you?
So this portfolio, the high conviction list that is there, it gets generated at the beginning of every month. And the number of stocks or the ideas in that could change. Typically bear markets, you get a wider number of ideas. Bull markets, you get a lower number of ideas. We haven't done a back to see what it is compared to other multi-cap funds that there. I guess because it could be still be a theoretical exercise. I think once the product is launched, you have the first portfolio, then one could do that analysis to see what it means compared to the other funds out there in the market and what level of overlap is there.
Another question: of late, a lot of money actually moving to penny stocks, which is not that kind of value to be invested. Some analysts are actually giving a lot of cautious call, but still flowing to that kind of segment. Are you seeing any serious threat on that side?
So we think that the penny stocks issue is a bit of a every bull market story, right? This time it has got a lot more impacted because of two things. One is during the pandemic, a lot of people became day traders and investors because unfortunately they couldn't do their normal routine and job that's there. The second is that you have the emergence of a lot of these online brokers like Zerodha, etc., which have done a phenomenal job, but it has created the platform to be a lot more easy and accessible to anybody and everybody. So we always find it to be very, very cautious when you even get close to any of those stocks that are there, because in many of those cases, those companies actually have no right to even exist, let alone be listed as a company. So it's quite dangerous to be in some of those stocks.
Sir, your advice to the new kind of investors who joined to the party in the last 2 years, they only seen the upside market and they had a beautiful cakewalk in the last 1.5 years. They feel that it's quite easy to make money from the market. Do you have any kind of advice to that category kind of investors?
Yeah, if you don't have the stomach to bear 50% loss on your portfolio, then get out. Consider yourself extremely lucky. Count your lucky stars that you made a pot of gold in the last 2 years. But don't expect that this will continue forever. Equity markets have amazing ability to give you a tight slap every now and then. by giving a nice 20-30% correction every now and then. If you have the wherewithal to continue to hold on to your portfolio, if you hold on for 10 or 15 years, you will continue to grow this wealth that you have created. We've seen that in the past. There are very strong bouts of volatility. People who have the ability to stay in the volatile periods and invest further continue to grow their wealth. So have the stomach to bear the volatility. If you don't have it, take the money off the table and then park it to something where you won't lose sleepless nights, right? I mean, equities are the only places where people only enjoy the prices when they go up, but they don't enjoy when the prices go down. In fact, in any other product category, we enjoy it when the prices go down, right? Because you're getting better value. Right? Let's apply the same principle to equities. If prices are down 50%, I'm jumping with joy because I can buy more.
Nobody want a discount sale in equity market.
Yeah, nobody wants it.
Yeah. This mad IPO rally, IPO rush versus LIC IPO. LIC is now every day we are getting n number of calls how to apply LIC IPO. Are you going to apply in the LIC in your portfolio, or you?
In
Sorry.
the multi-cap fund, it will be a function of what is the analyst view. If the insurance analyst believes it is something to, it's a strong conviction idea for the insurance analyst, then we would look to invest in the company. We haven't yet met the management of LIC. So once we meet the management, we understand the DRHP was just filed last week. So once we get a better clarity on numbers itself, we'll be able to make up our mind on LIC itself.
Sir, few sector-wise question about NBFC and oil marketing companies.
So NBFCs have done reasonably well. They have a lot of regulatory changes coming up to them. The RBI has recently changed some norms on how NPAs are actually getting reported. So there is some bit of a challenge on the NBFC front, which is why we prefer banks today rather than NBFCs itself. Secondly, NBFC is also getting a lot of risk from all these new age tech startups, all these fintech startups that are there. Right? They are essentially operating in the NBFC areas that is there, because in NBFC they can charge a very high level of interest rates and look to make a spread out there. So that's something. The oil marketing companies, well, they are cheap. They have been cheap for a very long period of time, and the only reason for their cheapness is that the government is a large shareholder. And we've seen that in the past and continue to see it, that wherever the government is a large significant shareholder, the true value of a company never gets fully reflected.
Sir, the last question, especially the call from Middle East, always there will be a question on gold as well. Gold is almost 11 years, it was struggling. In fact, now almost we are back to 2011 kind of numbers. What could be the expectation now henceforth on international gold? Because many of the Indian investors, they are not aware about how the international gold prices are moving. They just see the gold in ANR. But gold in this part of the world, we are tracking either in AED or dollar. So we are well aware that it's just reached to same level compared to the last so many years. What could be the outlook now henceforth you're expecting again for a 3 to 5 year period?
So gold is always something where I personally believe is you're buying it purely when you're very fearful and fear is very high in the market, right? Situations of war, high inflation, bear markets. So that's when gold actually does very, very well. Otherwise, there is no way in which one can make a good judgment call of what should be the true price of gold. And in the past, we can look at 15, 20, 30, 40, 50, 100-year data. Equity markets have delivered better return than gold always has. Right? So gold prices go up, but they stagnate for very long periods of time. Over the years, gold is simply a reflection of the fear that markets have with regards to any underlying situation. So today, fear is very high. Therefore, a lot of investors are tempted to invest into gold. But for this time period is very unique that there is another counter to gold investing, which is all these cryptocurrencies, where a lot of the inflation or the fear factor has moved from gold to crypto, and people are investing out there. So on paper, gold should look attractive given the lot of fear factors out there in the market: interest rates, inflation, war, high oil prices. But I can't say for sure, what would gold be, say 1 or 3 years down the line.
Since you mentioned about crypto, Are you expecting crypto crisis? Crypto can be lead to a crisis, and it can be lead to a asset bubble across the world.
Oh yes, I think. So to be honest, when you look at the technology or the underlying concept of cryptocurrencies, it's a very beautiful concept, right? But and it was supposed to be this great alternative to gold, right? Gold is the ultimate crypto when you think of it, right? There is limited amount of supply. The concept of crypto mining comes from gold mining, right? That you actually have to do dig for gold. It's you cannot create gold, right? Whatever gold is there on nature's bounty on this earth, that's what gold is available to us. Uh, Gold used to be the original currency benchmark, right? And gold is what kept inflation and interest rates under control. And crypto was supposed to do all of that in a digital format. But here's where the concept of cryptocurrency or the original Bitcoin actually failed. Bitcoin was also supposed to be a limited currency, limited in supply, just about I think 20 odd million Bitcoins. You have to mine for Bitcoin. It becomes more and more difficult and more expensive. It is supposed to be an inflation hedge and protection against interest rates and government doing printing money, all of that. But I today have more than 1,000 Bitcoin or Bitcoin type companies, right? And when you think of it from that perspective, just today you have Bitcoin, you have Bitcoin Lite, you have Dogecoin. I mean, hell, I mean, tomorrow I can launch a coin of my own, right? And I can just call it shitcoin times two, Ruchit coin. We can have a Barjeel coin, whatever it is, right? What stops me? And which is what we saw, right? People would launch uh, cryptocurrency, NFOs, and stuff like that. What the simple logic being that, yeah, we're just going to launch a coin. What value it does is a surprise. So it is, in my opinion, my personal opinion, a massive Ponzi. Okay, you can trade out of it if you're very capable of doing it. Take very high levels of risk. You may make money, you may lose money, but I am staying like 100 feet away from anything that's crypto.
You will rather take a penny stock, but don't touch crypto.
In a penny stock also, that I can open up the balance sheet and look at it, right? Okay, is there something in this company? Are there some assets, some cash, some land, something, right? It's, I mean, it may be a penny stock, but there could be some value out there. In crypto, I don't know, right? I mean, how do I give a value of Dogecoin? I have no idea. Elon Musk tweets about it and Dogecoin goes up. Fine.
Thank you, Mr. Ruchit, for your in-depth coverage about the market and cracking our new fund, SBI Multicap Fund. With you all, we are expecting a good value in anybody's portfolio. This multi-cap will bring a better diversification and better return to overall portfolio. So we urge our customers to give a proper allocation to multi-cap segment. Especially, we feel enough for this point of time, especially fund manager got a time to allocate money to the market than jumping into a market on a single day. So this will make a real sense in everybody's portfolio. Actually, this webinar we conducting after the new era of holidays in UAE. We moved to Sunday holiday from this January. Saturday, it was a bit kind of confusing whether how many participants will be there for today. We got more than 300 participation in Zoom, as well as it's parallelly going through Facebook as well. So on behalf of our all clients, as well as on behalf of Barjeel Geojit, I wish to thank you for your valuable time and input. Thank you once again, and looking forward to such events in future. Thank you, sir.
Thank you, everybody. Thank you for your time. Thanks, George, for having us.
In the last 25 years, the returns on various financial asset classes like bank deposit, gold, and real estate have multiplied several times. But there are a few select investments in the Indian capital markets that have had the potential to appreciate exponentially over 100 times. If you had known this at the right time, you would have taken the right investment decision, which is precisely why you need an expert's validated advice when it comes to investing. Welcome to Barjeel, one of the few SCA-approved financial intermediaries in UAE. We are wealth builders, guiding customers since 2001. We have serviced over thousands of them till date, and today we cater to large segments across investor groups. This speaks about our enormous goodwill and their undiluted trust. And we have earned that trust by telling, not selling. We educate you on the investment opportunities that are ideal for you. We then help you make an informed decision, impartial and unbiased, keeping your long-term goals in mind. And with us, everything is long-term, be it commitment, relationships or success. We offer comprehensive insights across a wide range of products through a holistic approach. We ask you the most important questions, the answers to which will help you focus on your investment objectives. For example, you work for over 30 years. Are you saving enough for the next 30 years? For life goals like children's education, your daughter's wedding, or your retirement. Think about it. You work hard to earn your money. Does your money work hard enough for you? Barjeel, let's build your future. Come, let's talk.